Hello guys, this is Engineering Wealth Journey and I'm here for video 4. Now this time I'm going to be talking about the coronavirus scare and I'm going to be talking about asset allocation and what to do. So just quick update, net worth it's down again. Seems that based on the 600 point drop in the Dow, it lowered my net worth even though I did add money. Currently I am aiming to fully contribute 100% of my paycheck, so right now I am losing some money, but overall it's decent. I've been stuck at around the 110,000 for about 1 month now, so we will see on how this goes. Asset allocation, let's just go for a quick portfolio asset. So I'm still at 66, even though I did add about $2,700 into the stock market. So I did technically drop $2,700, but that's expected. I have no worries because technically I'm still heavy in cash and I'm actually investing 100% of my income into the stock market. So right now I'm just slowly lowering my savings in cash because technically I do have too much cash. $4,000 in cash, and since I'm not sure if I will buy a house, it's technically not that useful. Most likely I will invest $5,000 to $10,000 either into some large cap funds or maybe some bond funds. In addition, I will probably be moving a lot of my savings account portfolio into a bond portfolio because it just doesn't it's not inflation protected for the bond savings account portfolio. But if you invest in bonds, you are inflation protected, usually at a rate of return of about 4% a year, which is basically the real inflation. I do not believe that the US Federal Reserve gives an accurate inflation rate of 2% a year. I think that is a severe underestimate, and therefore I will use bond funds to make sure that my money keeps adjusted to inflation. Now, of course, I will try to only invest in what is more, such as the Vanguard Total Bond Market Index Fund, which is composed mainly of 70% government bonds and 30% corporate bonds. So the chance of failing is almost 0% unless the entire government fails, which is extremely unlikely. So you will see that as my savings account slowly drains and it goes slowly into investments. Now, as you can see, I am in about almost 70,000 in investments, which is much higher than what I had before, which was a lot less. So to continue, what you want to do during the market when it goes down, such as you see all these news, Dow tumbles 600 points. Technically, the points, no one cares. It's totally useless. No point in that. We're looking at the percentages. We're looking at 2%, 1.8%, 1.6%. So what you want to do is that since you see a drawdown of 2%, 1.6%, 1.8%, then you start slowly buying or you get ready to buy, which means, such as myself, I am transferring money from my savings account to my bank account and then to a brokerage account. And during the brokerage account, I'm going to use that money to buy. And that's how I will be preparing, buying the dip, as you say, because you don't want to sell when it dips. The only time you do want to sell when it dips is you can see a foreseeable bankruptcy, right? Then you might want to get out, right? If you have a huge lawsuit, you might want to get out. So some people in the 2008, they got out before Lehman crashed, Bear Stearns crashed. That's smart. Do that. But if you're talking about just overall index funds, since index funds can't fail unless the entire index fails, which would be basically if you're looking at the S&P 500 index or the total market index, you're looking at 60-70% of the stock market failing, and that's usually impossible because for that much money to fail, the government would collapse and the government would just bail them out again with the Federal Reserve. So that will not happen. Therefore, you want to buy the dips. And what I suggest is that you can see that Caterpillar, one of the biggest conglomerates, industrial, you can see that the projections for the future earnings is low and guidance is lower. And therefore, you want to watch those stocks that you might want to buy, since always buy the dips. For instance, Facebook had a bad earnings report and they might keep dropping a bit. That might be one of the stocks that you might want to buy into, because Facebook will be still one of the best earning stocks, one of the best growth stocks that you want, because it just makes so much money and it has so high growth. You can say what you want about the company's mission, but there's one thing you can't ignore: very high growth, very high income, and therefore the stock should match that growth and income. So now, since I talk about that, we also want to be checking the airlines, because airlines do have a great PE ratio right now, and therefore they're looking to be a really good time to get into the airlines within the next few days. And therefore, you want to look into buying airlines if there is something that you do want to get for cheap and value. So that might be one of the best times to buy the dips. Now, if you're wondering how much the coronavirus might affect the economy, we're looking about, if they projected that if the Spanish flu occurred currently, it would cut around 1% of GDP, right? At a max of 0.7%. If the 2003 SARS went close to the Spanish flu. But because of the quarantine, that's unlikely to happen, and therefore we're looking at about 0.5%. Estimation time would be possibly a few months before everything stabilizes, and then it would probably be uphill from there. So what you want to do is that you want to start looking into some safer assets to asset allocation before you transfer to riskier assets if you want.